Hello, everybody. It's Simon Dixon here, and welcome to another live AMA. Today's session, we're going to be discussing three monetary systems colliding and what a couple of weeks it's been. Hopefully, everything's working okay. If everything's good here, can you use the live chat? Let me know everything's good. We're just on YouTube today, so I'm checking out the live chat. Let me know if you can hear me okay, where you're from, and where you're tuning in from, and I'll check out that live chat. We've also got Azad here, who's going to be moderating, and he will let us know as questions come in. Awesome. I can see a few comments in the live chat. Yeah, let us know where you're tuning in from. We're really curious. So yeah, today, just while we're waiting for everybody to arrive, I really appreciate a thumbs up and a like button. That helps the YouTube algorithm give us some love and get more people on here. It's been a wild 2 weeks, and today we're going to be discussing the three monetary systems colliding. We got a slightly different setup today, so I'm just making sure everything's okay, and I think we're all good. Also, hope you appreciate the new microphone. We got the new studio coming in soon. The first step was the microphone and the mixer. Then we're going to have a whole new setup. We're still in lockdown, so there's still some challenges coordinating and getting everything together. Hope everything's nice, safe, and sound where you are today. Good to see the live chat moving. Welcome, welcome. So I'm going to dive straight in just while we're waiting. Please do share this link. Subscribe to the channel on YouTube if you're not a subscriber already. And later we'll send this out on Twitter and Facebook as well. So I see quite a lot of confusion at the moment around these different forms of money. And I've also seen this new term really become something that's being marketed and talked about. And I'm really surprised to see it, because this is what we were talking about back in the monetary reform days, before I joined the Bitcoin community in 2010-11, before I wrote the book, Bank to the Future, which was the first ever published book to include Bitcoin. It was called Bank to the Future, Protect Your Future Before Governments Go Bust. And before I spoke at that very first Bitcoin conference in Prague, I was part of a community called the Monetary Reform Community. And the Monetary Reform Community it was nowhere near like the Bitcoin community today. But we were discussing different ways of money being created, different economic models, and there was nowhere near as much momentum. But what I'm really surprised to hear about today is a lot of people talking about modern monetary theory, MMT. You probably hear that phrase. Now, that was a very rare phrase to be talked about. But now there's a real popular school of economic thought around. Now we're seeing all of these trillions and trillions being created by the Federal Reserve and central banks all around the world, in Europe, and more Chinese yuan being created as more and more dollars enter into the People's Bank of China due to their capital controls. All of those dollars that are being created, as they make their way over to China, as China is still exporting a lot of goods, that actually exports any inflation. So because China has capital controls, when you pay something with dollars, it goes into the People's Bank of China, which is the central bank in China. And then they have to print new renminbi if they don't have enough on reserve to actually meet those obligations to the companies that are actually exporting those dollars. So in this way, you get renminbi being created at a similar rate to the dollars that are entering China as the largest importer of goods that are made in China. Then obviously China takes those dollars and they end up investing them because they want yield, and they can't find enough gold, because at the moment you can invest in paper gold or you can invest in physical gold. But there's not enough physical gold to actually meet all the obligations of all the paper gold. So all of these derivatives around the world that give you entitlement to gold, if everyone actually tries to get physical gold, as we saw during this breakout, you can see that the physical gold doesn't actually exist, and you enter into a shortfall of physical gold when people start to realize that paper gold is not the same as physical gold. And so China, the central bank of China, has been trying to swoop up as much physical gold as it can, store it in the coffers of its central bank, because I'm forecasting a Bretton Woods style 1944 style monetary renegotiation, as central banks around the world are destroying their money supplies through these quantitative easing, stimulus packages, and everything else that they're going to have to do. Now we've had lockdown 2, and some of the stimulus packages, obviously US is more discussed because the Federal Reserve is essentially propping up the entire economy, and its monetary policy is being exported globally because so many are you've got 70% of all global transactions in currency in the world being held in dollars. Central banks all around the world holding those dollars and then lending them back to the US, which is why they're getting record levels of government indebtedness in order to meet some of these stimulus packages. But China's sucking up a lot of that gold to try and actually get a seat at the table during this monetary renegotiation. And I've also talked in previous videos about the different forms of money. Today, I'm actually going to focus on these 3 different forms of money. And I think it's really, really important to distinguish these because so many people get these confused. And it's because the jargon is confusing. Obviously, the new meme and the new mantra is the whole printing press of you see those dollars being printed like crazy. And if you've watched previous videos of mine, you know that I talked about a couple of videos worth watching. Who makes money from printing money? And it goes through the 6 different types of money and who profits from them. And you'll know that printing money is actually a pretty misleading term because the printing press refers to money that's created by a government. And that is the first type of money. Money created by a government is very different to the other types of money. And so the printing press is a meme, as it were, for governments creating money because they actually don't create digital money. The central bank, the Federal Reserve, they create digital money. So they fire up digital money, which doesn't come from a printing press. And they use that new money in order to either purchase assets from companies through corporate bonds, or they purchase assets like government debt, so that they actually are essentially creating that new digital money and lending it through quantitative easing to the Treasury and government, because obviously they're spending way more than they're collecting in tax. And in fact, we're actually reaching the phase soon where the amount of obligations and interest that the US government and Treasury have to pay to service all these treasuries that they've created is actually going to almost be equal to tax collection. So the amount of money that they collect in tax each month is almost equal to the amount of interest that they owe on those treasuries and other government bonds and instruments. So it's a bit of a misleading term because governments actually don't create that much money. They've outsourced it to 2 institutions. The main institution that's creating most and the largest majority of money in the world is actually the private banking sector. So government created money is what people are talking about when they're talking about modern monetary theory, which is essentially recognizing that governments have full authority to create money, even though they don't. They essentially borrow money from the Federal Reserve, but they have full authority to do it. And it's actually, if governments create it directly, as I talked about in the book Bank to the Future, it actually is a more efficient way of creating money because you can have one transparent money supply called M, rather than these very confusing different forms of money like M0, which is the base money. And then you have M1, M2, M3, M4, which is money being created through credit and various other things. But now modern monetary theory is becoming debated as something that could actually happen. And the modern monetary theory people are out there, talking about that. And actually, this may come a bit shocking, but I'll summarize at the end of this video or the end of this section before we get into the AMA, why we might as well have fiat money subject to modern monetary theory if we're going to do that. So 3 forms of money colliding. First form of money is government created money. At the moment, it's just cash and coins. And they're relying upon the central bank to actually create money, and the governments are borrowing it rather than creating it direct. That has a few effects. It can be inflationary when you have to factor in all this interest repayments. So the government has to factor in all these interest repayments, which means that they have to make more and more tax collection from individuals. And more tax collection means that in the future, under normal circumstances, without the crony capitalism that we're experiencing right now, that should lead to a price increase, not just due to the traditional monetary theory put forward by Milton Friedman. And remember to check out my YouTube channel. If you go way back to the archives, in 2011, I published a video called The Great Depression of 2020. And I talked about the different economic theories, Keynesian, Friedman monetary theories, and how those actually relate. So Milton Friedman was, the monetary theory guy, and Keynesian economics is the whole thought that governments can actually spend their way out of recessions. The bit that Keynesian economics actually gets a bit too much criticism because we don't actually have Keynesian economics. We got half the story. Keynesian economics states that in times of economic depression and recession, like we're experiencing right now, that governments can spend and do what's known as a fiscal stimulus, which is where the government can spend, take on debt, and try and recover the economy. But the bit that Keynesian economics actually talked about is during good times, during boom markets, that debt should be repaid, which is the bit that everyone's missing. So everyone's judging Keynesian economics based upon half the story, but we don't actually have Keynesian economics. We have something closer to Marxism, essentially, where now everyone's relying upon the government for their income because of these lockdown measures. And therefore, everybody's actually, the governments are actually propping up the property markets because they're paying some income, which is allowing people to cover their mortgages in an economy where the majority of people are living month to month. So we're in that hybrid model, kind of disguised as capitalism, but not quite there. So the first form of money, anyway. So I talked about that video, the Great Depression of 2020, and monetary economic and monetary theory. So government-created money is a very small fraction of money in the world today. If you take a country like the UK or the US, notes and coins only represent about 3%. The second form of money, which is colliding right now, is the form of money that is completely broken, has systemic risk in it, and is actually what I call free market money, but vastly regulated and subject to crony capitalism. So many people criticize, particularly economists, like more free market economists. So free market economists are originally classical Adam Smith economists. And then you have more, other theories like Austrian economics, which kind of believe in monetary theories like gold and competing currencies, which is an interesting thing that I think we're going to be moving towards. But most people attribute what we have today, which is the creation of digital money. So if you've watched any of my previous videos, I talk about these three things, and this is what I talked about in the book, Bank to the Future, Perfect Your Future Before Governments Go Bust, is that banks essentially are given special privileges to create digital currency. They were the inventors of digital currency, and they created it long before any private form of digital money came along, like either e-gold or later iterations, and then eventually Bitcoin as the one that actually worked after all those early iterations. But the second form of money is what I call free market regulated money. And so it's not full free market, because a full free market would mean that there's no regulations in the middle that end up creating lots of crony capitalism like we have today. But free market in the sense that government's not creating this digital currency. So the digital currency is created through a process that is misleadingly titled fractional reserve banking. And the three forces I talked about in my book, Bank to the Future, were that through this process, Banks actually own all the money deposited at the bank. When you log into your online banking and you see money, that money is actually digital. It's not, you can convert it to government created money by going to an ATM. And if too many people go to the ATM and withdraw government created money, which is cash and coins, then the bank actually uses some of its digital currency that it created and purchases more money from the treasury. And that is actually known as seigniorage. And seigniorage is the process of governments creating notes and coins and selling it to a bank, and the bank buys it with their digital currency that they created. And that is actually swapping money, and it's added and it reduces the amount of tax that one needs to pay in order to meet all the debt obligations that governments are running at the moment. And so governments can actually create money, sell these cash and coins, sell it to banks, but then they want to make cash illegal. So when cash becomes illegal, which the war on cash is lost, it's done, it's not worth debating. It will be over in the future, and especially as this this health crisis, where people are talking about cash and coins, containing or spreading the virus. Then you can bet that cash is just not going to be a part of our future. There's only a few use cases that are remaining that keep that cash alive, but it's a lost cause. It's not worth fighting for. But free market regulated money has those three forces, which is banks own it, banks create it, and banks can spend it as they choose. And that is what we call dollars, euros, pounds, that does not exist in your pocket in paper form. It's regulated because it can only be created if you secure a banking license. So when I first co-founded Bank to the Future, we tried to create what's called a non-fractional reserve bank. It turned out that it's impossible. Now the technology exists to make it happen, which is why it's such an interesting time in financial history. But when we tried to create it back in 2010, there was no thing called a challenger bank. And when we spoke to the regulators and said, we want to create a bank where we don't own clients' money, we can't spend clients' money without their permission, and we can't leverage assets, the client money. The reason it wasn't possible is because we, as an alternative financial institution, you can't get direct clearing into the central bank. That direct clearing into the central bank is a privilege that's only bestowed upon those that can get a direct clearing banking license. And in countries like the UK, there's only about 5 of those. In countries like US, there's more. It's a more competitive market. And other countries, there's different types of systems as well. But it's what I call free market regulated money. The reason I call it free market is because it's actually created by the private banking sector. The way that it's created is if you go to a bank and you ask for a loan, if you take out a mortgage, the bank has the ability to create a new digital currency that's a representation of the currency you're borrowing. So if the government creates dollars, or the central bank, the Federal Reserve, creates dollars, private banks have the ability to create digital dollars every time they issue a loan. If you repay that loan, or the loan is defaulted upon, that digital dollar disappears and it no longer exists. So banks try to create as much digital dollars as they can by issuing as many loans as they can, and then take the risk and sell it to your pension or pass it on through collateralized debt obligations and mortgage-backed securities and all the crony capitalism products that essentially were backed by government institutions like Fannie Mae, Freddie Mac, and various other government guarantees like the Federal Deposit Insurance, and other countries have different insurance schemes that can't meet all the obligations that they're insuring. And they essentially get to pass on all that risk but create the money. And they benefit from any of the interest that's created from that digital currency. So regulated because it is very hard to get those banking licenses. And they say things like you have to pass stress tests. But what they tend to do in order to pass those stress tests is they meet the regulatory requirements, but then they use different divisions of the bank, like the investment bank or the investment institution, in order to leverage many times over. In the case of companies like in the last financial crisis, we saw Goldman Sachs, which was like 365 to 1 leverage, rather than actually holding those 10% reserves. But when the shit, when bit gets really bad or shit hits the fan, they try to recapitalize by changing the category of what the retail. So they change the investment bank to a retail bank, because then they can take advantage of some of those insurance schemes as well. And they can get access to bailout money, insurance money. And so they get to go in and out through this crony capitalism, playing different regulations, but it's all free market money because the government's not creating it. Banks compete with each other to create this money, this digital currency called the digital dollar. And this is the main source of money in the economy. It was only in times of extreme measures that the central bank comes along and creates digital currency through quantitative easing. We first saw it during the Great Depression of the first, the last famous Great Depression of the 1930s. It wasn't called quantitative easing then, but the term came along when the Bank of Japan, during the last decade, actually created this term quantitative easing. And then obviously in 2008, 7, 8, during the financial crisis, quantitative easing became a serious form of creating digital currency by the Federal Reserve. Now, remember, it depends which country you're in, whether the central bank is actually, a part of the government or not, because there's different mechanisms. Most central banks were started as private institutions to lend money to government during times of war, when they have extreme financing requirements. And normally, the Bank of Royal Families, but that's what in the case of the Bank of England, it was created as 1694 as a way of lending money to the king at the time, so he could actually fund the wars. And the Federal Reserve was actually funding both sides of wars in 1913, and various other historical events that led to that. But eventually, some of these central banks, so in the case of the Bank of England, it was nationalized and made a part of the government, but still maintains independent privileges to try and keep politics and money creation separate. That's a really important distinction that needs to be made in the monetary renegotiation. At the moment, there's not enough independence between politics and trying to control the money supply and create the money supply. Forms of money. So you've got government created money and you've got free market money. At the moment, you're seeing a war between free market money, where banks are essentially trying to recapitalize ever since 2008 and the stress test, and then central banks coming along and creating quasi-government type of money. But to those out there, most free marketers and libertarian-minded people in Austrian economics consider fractional reserve banking a government initiative. And that's because of regulations, but it's actually a more free market form of money than the types of this digital currency could no longer change. Fix the supply at 21 million. Nobody can change that unless it has some consensus, but it's pretty much impossible to change. This is privately created money. It's created every time anybody can, originally anyone could fire up a laptop and start mining Bitcoin by verifying all the transactions, performing the role of the bank, auditing every single transaction, and maintaining a copy of every single transaction throughout history on their computer. The more and more supercomputers or computers that are doing it means that you have a backed up record of every single transaction, that if one miner tried to change a transaction, it would be out of sync from all the other computers. And now Bitcoin has become the largest supercomputer that's ever existed in human history. And therefore, there's so many backed up copies of every single transaction that if anyone tried to do funny business, they'd actually have to perform very sophisticated attacks on supercomputers all around the world and spend billions and billions that would eventually lead to some kind of fork in the code that would actually take out that need. So the incentive, and that's why Bitcoin is so different from other cryptocurrencies, because of the fact that trying to change it is just virtually impossible and very hard to do. So that is the third form of money. You have government created money. A fourth one is central bank created money, but to not put too much complication into this, we'll sync those up because I talked about the relationship between government created money and central bank created money. You've got free market regulated money, which is fractional reserve banking, which is private banks creating digital currency every time they issue a loan. And then you have competing fully free market forms of money, which is natural forms of money that come out of the ground or were created through the Bitcoin blockchain as well. All of these are subject to manipulation. So some people might confuse and say, well, one can be manipulated. Well, all of them can be manipulated. It can be manipulated by very, very wealthy people. It can be manipulated by central banks. It can be manipulated by governments, and it can be manipulated by many, many different forms. But the point is that the form of manipulation and the transparency of the manipulation is different for these different forms of money. So with Bitcoin, for example, and gold, many people accuse it of being manipulated through paper markets. In the case of Bitcoin, because it's less liquid than gold, gold is like a multi-trillion-dollar market. Bitcoin is a $200 billion market. It's growing a lot, but it's a fraction of the size of the market of gold at the moment. But a lot of people are diversifying into Bitcoin, which is pushing up the price. There are only so many Bitcoins. Over 18.5 million of them have already been mined. And, traditional theory of inflation is, too much money chasing too few goods. If more and more money is entering into the Bitcoin ecosystem, then the only way you can have is some kind of price inflation, which obviously price inflation means that if the value of Bitcoin is going up and up and up, because there's too few Bitcoins being chased by too much money, then obviously the purchasing power of those that already own Bitcoin is increasing, which means that the overall effect is that you have a deflationary effect. The value of your money is increasing, which means that you can buy more goods, which means that you can purchase more and more for as the value increases. I know these are, inflation, deflation. It's a confusing topic because some people just bundle it together. Most people consider inflation in price and increase in the price of goods, but some goods could be inflated, and then others could be the subject of decreasing costs because of economies of scales, network effects, technological innovation. So it's very hard to bundle it together. And then you have things like asset price deflation and inflation, which is very different. So to summarize these three things, you've got three forms of competing money, and they are all colliding right now. My forecast is that you are going to end up with two forms of money during the monetary renegotiation, which is that if we're going to use government-created money, we might as well move to a more transparent central bank digital currency with one form of money called M, and central banks could be independently, and I talked about this in the book in 2010, responsible for controlling inflation and deflation, independent of politics. That's a hard one to crack. The government are using fiscal, and the central bank are using monetary policy. And you need to try and ensure that those two are independent. That's a tricky one, and it's never really worked throughout time. But if you are moving to a more transparent form of money, then you might as well have governments just creating it rather than outsourcing it in the middle to the private banking sector through a Ponzi scheme called fractional reserve banking, where there is not enough money to repay all the debt. All of the money is backed by debt through this digital currency, and it leads to this ginormous rich-poor divide, whereby those are the closest to the central bank, i.e. banks that can borrow the quantitative easing money at virtually zero interest rates, get the cheapest form of credit, and then they end up re-lending that to the poorest part of the economy through payday loans and credit cards, which are subject to 20, 30, 40% interest. And you have this predatory rich-poor divide where those closest to the cheap money actually end up accumulating all the assets, because the private banking sector gets to actually create all of this money every time it issues a loan, but it's backed by the assets. So it's why property markets always go up in value over time with certain corrections, but they tend to double in economies like the UK, US every 7 years, is because essentially the favorite tool for banks to create digital currency is lending it to you through a mortgage. By lending it to you through a mortgage, it means that they get to create money when they issue you a loan. And if you can't, they could package it up and sell it to your pension as well if they don't like the risk. But if you default on that loan, they can repossess the asset. And then this is what's, the banks can end up with all these assets in a liquidity squeeze or a credit crisis like we've seen. And therefore, they can threaten the government and say, bail us out, or we'll fail, end up accumulating all the assets. And you have this too big to fail conundrum, which creates moral hazard problems for those of you familiar with economic terms. I think that they're not going to do that this time. During the monetary renegotiation, what we're going to see at the moment is the first round of stimulus packages is being renegotiated in the US. The loans that the businesses took out that would have led to record bankruptcies if the government didn't lend to them through this stimulus, in the US, many of them, if they keep all of their staff employed up until the end of October, then they don't need to repay those loans. So once October rolls around, if you don't get a renegotiation, all of those companies that borrowed the money that kept them alive can fire all of their staff. You get ginormous unemployment again, unless this is rolled over through a second stimulus package, which would then lead to more money being created at the central bank level through QE. Then you're going to see ginormous levels of unemployment in the US roll around about October, because many of those companies, they're only continuing to employ those staff because they don't need to repay the loan if they continue employing them till October. So this is causing a bit of a delay in the systemic risk effect. Once those things that essentially the world is now addicted to QE money. Without QE money, you would have what we need in the economy, which is deflation, asset price deflation. We need stock markets to crash. We need real estate markets to crash. That's not necessarily a bad thing. It's very bad for those that have accumulated assets, but for those that don't have assets and just have debt, it means that real estate coming down means that they can start to acquire real estate at more affordable levels. But that's what the government doesn't want. They want the rich to remain holding all of these assets. And so your game is to really make sure that you're on the right side of that trend by playing the debt markets in a clever way. And that's what I'm going to be talking about when I release in September, the 4-part video series where I'll be going through exactly how to get on the right side of that debt cycle, and what I'll be doing to play the markets with my savings, as around about October, you start to see the effects of what will officially be titled the Great Depression of 2020 from my perspective. It won't be called that until 3 years of history, but we could be in it because the definition of a depression is slightly different. And so, the definition won't be known until towards the end of this year. But that's why I want everybody to be prepared for these 3 different types of money colliding. So I think the middle form of money, as you've seen, if you've checked out previous videos of mine, one of them was called the real estate market crash and the 10 steps to happen next. And I also reviewed that in one of my recent AMAs. Make sure you subscribe to my channel on YouTube, like it if you're enjoying this content. I want more people to see this. I want more people to be prepared for what I think comes around in that October period. But again, I'll keep you up to date on all my AMAs because it all depends on what the politicians renegotiate and what they do next. So I'll be preparing for those different eventualities, and the 4-part video series that I'm going to create is actually going to be going through exactly those different scenarios and how to protect and prepare yourself. So please do share this content if you're enjoying it, like it, retweet it. Really helps us. Want more and more people to see that. I think more and more people are going to need that. But in the previous video where I talked about the 10 steps that come next, one of them is real estate market crash as a result of people that are living month to month. And that has systemic risk effect on the banking sector. And that's when I'll be finally getting the calls, I guess, from the TV shows, because we'll start talking about the banking crisis at that stage rather than the health crisis and the economic crisis that we're experiencing right now. So that's what I want everybody to be prepared for. And so I think what's going to happen is governments are just going to take full control of the money supply. They're going to let banks go bust, and they're going to issue a central bank digital currency in proportion to the deposits that are no longer insured because of the Ponzi scheme, with these insurance schemes that don't meet the obligations if banks go bust. And they're going to reverse the too big to fail scenario where the banks are holding governments to hostage through essentially their too big to fail properties that would completely annihilate the economy and destroy. Instead, they decided to destroy savers through a period of negative interest rates, low interest rates, so that you can't receive yield on your savings if you have been saving, punishing the saver, rewarding the borrower, and encouraging crony capitalism. So I think the first form of money is going to be a central bank issued digital currency, and we're going to move to modern monetary theory, let the banks go bust, open up the API keys at the central bank, allow financial technology companies to build on top of it so that they can start servicing customers from this new form of money. And check out previous videos where I talked about the effect that this will have on your privacy, your freedom, and your personal sovereignty, because this is going to get pretty ugly, this first form of money. The second form of money, I think, is going to be subject to a systemic risk event. And thank God we have the third form of money, which is completely independent of government and politics. It exists out of the ground in case of those of you that want to store a value. And those of you that want to receive returns, because a store of value tends to maintain your wealth rather than increase your wealth. You have things like Bitcoin, which is a more speculative store of value and therefore produces higher levels of returns. As we have seen since I've been creating these AMAs, you have seen really strong results from those asset classes. And anybody that's been regular watcher of my YouTube channel, subscriber throughout the whole crypto bear market, throughout the birth of Bitcoin, when I uploaded the video of me speaking at that very first Bitcoin conference, and also in 2011, forecasting that Great Depression of 2020. We'll obviously be on the right side of this, but obviously going to cover more. So that's the three different forms of money that I wanted to talk about. In terms of, they're all subject to manipulation, as I said, which is why traders always get crucified. If you're not an insider, my belief is that you shouldn't be trading. Traders like to, it's just a game of manipulation, and you have to try and get on the right side of it. But that exists with government created money, the free market money that's regulated, and also the fully private money as well through market forces. And remember, market participants can be governments, can be central banks, can be any. But I believe that fiat money is going to be created by the government rather than created by the private banking sector. And I think private money is going to compete. And then we're going to have different forms of private money as well, performing different functions, like you might see Facebook and various other institutions get through the regulatory loopholes. Why are they going to do that? Well, eventually Facebook's going to have its currency. And the reason it will get past the regulations in the end is because this is all about data. China is creating its own central bank digital currency. And at the end of the day, as we know from Edward Snowden and the Snowden revelations, the government has a back door to everything that we put inside Facebook. And if they launch a global digital currency with 2 billion users, then the US gets access to all of the data that it wants, and it will be done through Facebook. So eventually they'll let that happen so that they can gain access to the wider markets. But eventually, I think the middle person is going to be abolished, and we're just going to have government money competing with private forms of money, and the banks will adjust. And now we've seen, in the time that I've been recorded this video, banks are now allowed to custody crypto assets, and more banks are entering the market to hedge their bets and take a look at some of the different forces. So that's the topic that I wanted to cover. I'm just taking a look at the live chat. Thank you to everybody that has joined us and participated in the conversation. Let us know what questions you have. Azad's going to be going through the troll box and picking out some questions. How are we doing for time? Did I talk over the... I did 40 minutes. I was meant to do 30 minutes. I got too excited. 10 minutes over. So we've got 20 minutes to answer as many questions as we can get through.
Okay, yeah, we do have a lot of questions there. Simon, can you hear me?
I can hear you good. Hopefully the audience can hear you. Can you let us know if you can hear Azad? We've got a bit of a different setup today, so it's coming through the mic. We'll get better at these things as the professional studio comes through, but hopefully you can hear that. If not, I'll repeat back the questions anyway. But let us know in the live chat if you can hear us good.
All right, so we're getting a couple of people saying no, that they can't hear me. So I'm just going to jump straight to the question. As it sounds a bit far away, I'm actually very close. Okay, I think here's an interesting one. I've actually heard quite a bit with a few people that I know. There's with regards to commercial retail banks. Let me see. How does Simon see it playing out when commercial banks will start providing Bitcoin services as of next year, apparently?
Okay, so the question was, in case you didn't hear that clearly, is how does Simon see this playing out if commercial retail banks start custodying Bitcoin and cryptocurrency? Well, what I think is going to happen is a very similar effect to what we saw in the gold markets, which are the banks are going to they're going to start with custody, and then they're going to start creating paper versions of Bitcoin, like we saw in the gold markets. And then you're going to see derivatives of Bitcoin, like we have seen in the cryptocurrency markets. And therefore, you start to see these different versions, futures contracts, all sorts of stuff, which are not the underlying Bitcoin. So just like you're seeing right now, a shortage of physical gold because so much paper gold was created, I think you're going to see the same thing as banks start to enter this market. What is really important is whether the banks actually follow a trust and custody model. You may have seen in the press today that at Bank to the Future, we've actually shifted with our client funds to a trust-based model. So Bank to the Future is a platform for investing in the industry, in the equity and of the industry. And with our client funds, we're actually holding them in a trust structure rather than in a bank. The reason for that is because through a trust structure, it means that the trust actually has to ask your permission to actually use those assets if it's set up in the correct way. Whereas a bank, when you deposit your money at a bank, the bank becomes the legal owner. Now, obviously, remember I talked about in the very beginning, full circle, at Bank to the Future, when we tried to create the bank, we realized there was no way of achieving this. That's where the integration between products that exist on blockchains and trust structures can actually combine to create that non-fractional reserve bank that I was talking about. And many of the things that we're going to be investing in through Bank to the Future. But I talked about we're moving our client funds over to a trust structure because I'm scared of bail-ins and in the current environment. And I'm forecasting that we are going to start to see bail-ins, which means that any funds that you hold at a bank, the bank takes a certain segment of those deposits, like they did in Cyprus in 2013. And then you might end up with stock in a bank or some kind of other asset that they swap out for your cash so they can recapitalize themselves. So it's very important that when banks actually start custodying, they're going to do it in different models. And so when we do the course that I've all been talking about, I'll be talking about some of these legal structures so that if you ever do custody some of your crypto at a bank, is making sure that it's under a structure where those funds are legally segregated. So people often ask me, how do you store gold? Well, the best way to store gold, if you can, is with you in physical way. But obviously that's not feasible for some because of the dangers of having your gold stolen, which is why Bitcoin is a very good alternative in that environment because it's easier to store on you. But what most people do with their gold is they hold it in custody. Two types of custodians, there's more, but two main types of custodians. One is your bank. With the bank, through the legal structure, that custody gold could end up being theirs if they end up in a systemic risk event during the next financial crisis. With a custodian, they legally segregate that gold so that it's held in your name and hopefully under a trust structure with all the correct legal agreements. And because the custodian is not taking the same risk with your money like a bank is, therefore it should be better protected, but still not protected as if you could do self-custody. And so you've got to manage these different risks. And what we'll be talking about in the course is how to manage these different types of risks, understand the risk, protect yourself from yourself losing, your self-custody assets by hedging with some custody assets, but making sure the form that you hold those custody is not that. Now, I actually use a crypto-friendly bank. Part of what we'll be covering is crypto-friendly banking. And I actually use my bank because it's very convenient for the fiat money that I hold to be able to purchase through a bank. But then when it comes to the custody side, I'll have a different model than storing it with the bank for those reasons, because assets held with a bank are subject to bail-in risks and legal entitlement to those banks. So you got to manage these different risks, and part of what we'll be doing when we cover the course is making sure you know how to manage these different risks in a model when you're putting together your plan for how to do that. So I think it's a positive step forward. I do like using my bank. The reason for that is because when I have fiat money and I need to buy some crypto, I can do like dollar cost averaging where I can buy it every single month and stuff like that. And the intersection, removing the friction, is good. But I want to get that. I don't want to custody it with the bank. That's not something I'm comfortable with at this stage. But the convenience of FX, because I can then prove the audit trail that those funds were not the proceeds of crime if I ever have to spend it and convert it to fiat, and spend it in the traditional markets where you have to give all your source of funds, source of wealth, and all the paperwork, especially as it transitions to a central bank digital currency. So I think it's a good step forward, but you need to understand the risks that you're willing to take is the summary of the question. The answer, sorry. Azad, next question.
Yeah, just a quick one, if you can, on this particular subject. How can you be so sure commercial banking systems will collapse? I don't know whether you've mentioned that, but a lot of people are...
Yeah, the question...
There's going to be a collapse of some sort.
Yeah, the question is, how can I be so sure that central banks won't collapse? My investment income is preparing for commercial banks going through a systemic risk event. The reason I know that is because they are Ponzi schemes and they need to be restructured. But politicians could restructure them. That is very feasible. And they could end up, full reserve banks. They could be all sorts of stuff in the next monetary system. And the governments could actually take back control of money creation. And then the commercial banks could be restructured into like peer-to-peer lending firms and all sorts of stuff, different models that can emerge. With my investment money, I'm never sure about anything. I'm preparing for different eventualities. And so therefore, I have a portion of my wealth that's prepared for commercial banks never going bust, and also a portion that's preparing for commercial banks being taken down. But I do know that something's going to happen because it is a Ponzi scheme, and Ponzi schemes cannot continue forever unless the government decide to restructure, and that can go on for a certain period of time. But the commercial banks do have to go bust because the money does not exist to repay all of the loans. They have more debt than they do deposits. The more debt actually exists than deposit obligations. And therefore, we have to have some kind of restructuring as people don't pay their loans. If people stop, their money disappears, and that creates systemic risk event in the banking system, especially if you have real estate crashes. And because I know the economy needs deflation, it needs asset price deflation. I know the governments are going to try and keep asset price inflation and protect business as usual, because the world needs that in order to drive to some kind of sustainability so that we don't move to a world where essentially the 0.0001% own everything and they need you to have some debt and other assets so you can service your debt. Eventually, you're going to have some kind of restructuring. And one of those options is replacing all of your funds at a bank with a central bank digital currency, which I believe is the most likely outcome.
Okay, so we've got about 10 minutes, Simon, and 218 people watching right now. So thank you very much for all of you joining us. If you are new to this channel, welcome. Hit the like if you're enjoying this, and subscribe to keep up to date with the latest videos that Simon hosts. We have this like
they may not be able to hear you, Azad, so you might want to do
yeah. Okay, yeah, sorry about that. So Simon, I guess we've got 10 minutes left. So what would be great is if you could answer one question that has been repeatedly asked, and I've not really given it to you, and then give some updates, including the latest with Bank to the Future, and then I guess we can end it from there.
Okay, so update on Bank to the Future, and then the final question. What's the question?
The question is, what are the chances of global debt jubilee, and what implications does it have for people? So this is the interview that you did with Steve Keen. So lots and lots of questions around this.
Okay, so the question is, what's the likelihood of a global debt jubilee? And the definition of a global debt jubilee is essentially where the government or decide to write off some debt. And this was covered by Steve Keen in an earlier interview that I did. And essentially the effect of a debt jubilee is that it crucifies savers and benefits debtors. So if you've got a pension, you'll be shafted. If you have lent money through the markets, you'll be shafted. If you're a net borrower, if you're crippled with debt, then you will have a jubilee and your debt will be pardoned. The effect is that it essentially creates a ginormous redistribution from those who have savings and assets to those that are in debt, is essentially the system. And at the moment, because there's so much inequality, that could be a good thing or a bad thing, depending on which side of debt you are on. And I would be hedging that and preparing for that eventuality as well. The likelihood of it happening, I think you could see some form of debt jubilees, but whose debt will that be? It might be that we end up, so you've seen countries that have essentially just defaulted on their debts. I think that's a very likely scenario that you might end up with government debt jubilees. Will we end up with consumer debt jubilees? Well, what might happen is you could end up with a central bank issuing a digital currency, allowing the bank to go bust. So therefore you don't lose your deposit. And then all of that debt being auctioned off at a discount, which is not quite a jubilee. It's a market force for that. Or it could just disappear, which means that you as a saver, the impact it will have on the financial markets will be really, really so destroying. So you would see just such a shift in the financial markets under a debt jubilee scenario, but it will also lead to a redistribution of wealth from those that have wealthy and have assets to those that are in debt. Some might see that fair because essentially the forces of free market money under a crony capitalism regulatory structure means that essentially it's redistributed everybody into debt, and therefore that creates some unsustainable nature. But this is the type of thing that they need central bank digital currencies to implement because they don't want that debt in the private banking sector. So you'd have to take out the middle private form of money, have it at the government level, and then you can have some of these debt jubilees with fiat money competing with private money where Bitcoin just can't be changed, can't do a jubilee, can't change a code. So these are two really interesting thoughts. The other question around Bank to the Future, I'm actually going to release a video probably tomorrow because it suddenly dawned upon me. If you're a client of Bank to the Future, you know that we recently opened the ability for investors to invest in Bank to the Future from as little as $1,000 as a minimum investment, as long as you qualify. And it dawned upon me that I haven't really shared that outside of our usual Bank to the Future customers. So for those of you that may be interested in gaining growth to the entire industry, so for the last 10 years as an online investment platform, We've been, syndicating investments in many of the large companies, over 100 different companies in the industry. So we've accumulated a lot of assets as a company, and also, which means that if any of those companies go public in the future or pay dividends in the future, we receive a beneficial interest. But we're also a growth technology company through our technology to allow people to invest. And we're also going to be releasing some Bitcoin retirement products and all sorts of stuff. I'll release a video tomorrow just for those of you that are interested, which goes through how the investment work and how the proposal works. But for those of you that are customers of Bank to the Future, you can head over to banktothefuture.com, go to the pitches, and you can check out. And I'd really love to have many of our loyal followers that are subscribers to my YouTube channel. If you qualify to invest in your country, then we'd love to join this ride and join us on the ride of trying to build a bigger and bigger company at Bank to the Future. And as I said, the technology is getting really, really exciting now in terms of it is the most exciting time to be alive in financial history. And I think many of those visions that we tried to have in 2010, where we were too early, can actually happen now. So if anyone wants to join us as an investor, you need to just go through the qualification process and check out banktothefuture.com, and you can see the pitch here. Minimum investment is $1,000. And on this YouTube channel, for those heads up, for those of you that are interested, I'll put the video on this channel so you get a notification, and you can see if that's appropriate for you and something that you may be interested in. So I think that is the end of the broadcast. We've got, what should we do in the final 3 minutes, Azad? Should I just do a final summary?
Yeah, I think we should, maybe if you've got time for another question, seeing the fact that we did miss a couple, isn't it? There's lots to update.
Okay, Azad, if you can't hear Azad at the moment because it's too quiet, he said because we covered a lot, there's a lot of questions. I'm going to do one more question and then I'm going to wrap it up. So Azad, what you got for me?
All right, so obviously you've answered questions around the course, and we've got lots of that, and you've answered a few of that. But one that's people are asking: is it worth ever selling Bitcoin for fiat currency? Now that
Yeah. Okay. Great question. The question was: is it ever worth selling Bitcoin for fiat currency? And I really like the way that was framed. I think of it slightly differently in my head. So you have your funds that I've covered in previous AMAs that are for spending. And Bitcoin is pretty bad for spending because unless someone is pricing something for you in Bitcoin, the currency risk and volatility means it's very hard to plan your life around that. But in terms of your investment portfolio, to me, if I was selling Bitcoin, I don't know what I would buy. Because I'd have to buy some dollars or I'd have to buy some pounds, and I'd have to have a reason to do that. And that reason might be that I need more money in what I call my security bucket. And my security bucket is designed to hold funds so that I never have to sell any Bitcoin. It's what we essentially did at Bank to the Future. And we had enough dollars never to have, so that we didn't have to sell Bitcoin. And personally, I do the same as well. And the reason for that is because I don't want to sell Bitcoin. Bitcoin is where I want my reserves to be, subject to my portfolio breakdown. And this is something I will be covering in the 4-part video series. We've already covered that. And I want what I want to be in is a position where I never have to decide when to sell, when to buy, and I've got a fully defined approach. And that's exactly what I'll be going through. So I never have to make any of those decisions. But when you're asking me, do I just keep my Bitcoin? Well, it depends, because everybody has different financial plans. So you need to know how much do you need in your security bucket. And for me personally, at my age, I'm going to be 40 this year. I want enough in my security bucket so that I don't have to sell any of my assets for 7 years. That's just my personal goal and the way that I actually manage my finance. The rest, I want to be invested at risk. And I don't want to be, I don't want to be putting that in things like, following why cash is not king as a previous video I created. I need to be receiving, I need to be allocating that. A big part of that is preparing for the eventuality of two things. One, banks going bust mean Bitcoin still works. I don't want that to happen because it would be disastrous for so many people and it would wipe out so many people's wealth. But also banks being restructured and Bitcoin being a superior way to store your savings. And so even if that never happens, that traditionally for 11 of the last 12 years has produced outperformed any of the other, as Bitcoin has been the highest performing asset class, for about 10 of the last 12 years. So when I'm thinking of selling Bitcoin, I'm thinking of buying what? If I want to buy some real estate, well, I might do that because I want to live or upgrade my house. I might buy some gold because I want to stop, earning wealth and just preserve wealth in something more conservative. Or I might buy dollars because I want to actually make dollar expenditure, but I would want to get my security bucket to be in a position where I never have to make those short-term decisions, because that's what wipes people out, having to sell Bitcoin too early because they're either trading or they're trying to meet their living expenses. That's something I don't want to happen to you. So ending this now, I'm definitely going to be covering that in the free video series. And for those of you that want to use the whole approach, I'll definitely be covering that with those that join the course. The free video series is going to be out in September. I'll keep doing these AMAs so we can get as many questions in. And the course is going to be around that October period as well, depending on how we get on. We're actually creating the videos right now. Really, really excited. We're going all out on this. We've got spreadsheets, we've got worksheets, we've got videos, we've got all sorts of stuff happening right now. Really, really excited about bringing that to you. For those of you that want to join on the Bank to the Future funding round, welcome to head over to banktothefuture.com. Join us there. You can join us on that journey. So remember, no matter how bad it gets, you are alive at one of the most interesting and exciting times in financial history. A lot of people are going to get hurt, unfortunately. I want you to be on the right side of that. If you subscribe to my channel, I'll keep creating this content. I'll be back next week to take your questions. I'll release that video tomorrow. And we're probably going to be doing a lot more. So if you enjoyed it, please like, please share, subscribe to the channel, and hit that bell symbol. YouTube will give you a notification each and every time we go live, and we'll try and sort out the technology for next week so that you can hear Azad and you can hear the questions. So over and out. Thank you for your time. I'm going to go through the troll box. Let me know what you think, and I'll try and jump over to the live chat. Thank you very much.